Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
And so, he said, well, when do you think the stock market is going to stop going up and when it's going to start coming down, Andrew? And I said, I don't know. But what goes up must come down. And I know from a strategic standpoint, from a history standpoint, learning from history that, it can't keep going like this. That was 1997, 1998, Daniel. I'm Andrew Agemy.
And I'm Daniel Agemy. And you're listening to Financial Strategies. Today, we're talking about boom or bust. The next AI surge or another bubble. And AAA, it's good to see you today.
Good to be seen.
This is a thing we've been hearing a lot about. There's arguments on both sides that we're going into a boom, right? Yeah. AI is just going to print money. Markets are going to continue to go up. And then there's a lot of people who are thinking valuations look stressed. We've had high, right? There hasn't been average returns. There's been above average returns for the last 5 to 10 years. And people are thinking it's excessive. So where are we?
That is a wonderful question. I'm glad that we're going to address that today on today's show because, I think it's a question that a lot of people have. And I've been hearing it from people, especially this week, that, these are kind of dyed-in-the-wool stock market people that are saying, the market can't keep going up. And there are a lot of different things, whether it's the AI. Some people think it will go up and some, because of AI, but other people think it can't keep going up because of AI. It's like, in the late 90s with the dot-com era. And that's where I am. That's my stance on that because I believe that history repeats itself. And if you don't know history, you're doomed to repeat it. Because, Daniel, as I said to you before, and I said to people on the show that, 1999, I bought this great, fantastic, best thing since sliced bread mutual fund it was called Toll Keeper. And it was a great concept because it was all those things that you needed to use to get onto the internet. It was a great concept. And I bought an account for each one of my 8 children at that point. And I didn't invest a lot into it, but guess what? It wasn't but a couple years later, it was worth $0. Just like a lot of those companies, like everybody says, Amazon, if I only got an Amazon or Apple, right, early on. But how many companies were like Amazon and Apple during that time frame that didn't make it, that people invested in and they lost their money? How do you know which one's going to take, which one's not going to take? That's a very difficult thing for the average. That's a very difficult thing for the professional to know, let alone the average Joe.
So AAA, it's not like 2000. This time is different, right?
Yeah. Well, that's what everybody says.
Because AI, the internet was nothing like AI. Or if we go back to 1929, right? The AI is nothing like the radio. The radio is boring. AI is exciting, AAA.
That's the thing, Daniel, right? Proponents always say, well, this time it's different. This time it's different, right? But the concept is technology. Now, remember, back in the 1800s, technology was trains. Mm-hmm. When trains went across the nation and it was able to take product across the nation, that get a big boom. But what happened? Pretty soon, everybody got used to that, and it wasn't as much of a boom anymore. And then the technology of trucks came in, because now trucks were able to take things from the train to inland further, right, away from the train. And so that propelled things, right? And then time went on, and then it became other things, right? The radio, the TV, the jet planes, right? Taking stuff from one place to another, factories. But we go through these ebbs and flows, just like companies go up and down, right? They go in and out of favor. And that's why you have to watch. You can get a very good company. I remember Pfizer in the late 90s and such, it was doing really well, right? How many times, but then it started crashing. How many times since 1999 has Pfizer gone up? It has been in favor and then out of favor. 2 or 3 times over that period of time. Now, today is higher than it was a long time ago, but it's not higher than I don't think it's at a new peak. And then we're always talking about, oh, Daniel, the name escapes me, that company in 2000, we're always talking about, right? That Cisco.
Yeah.
How Cisco, it took what? I mean, they're just now getting back to the share price that they were like around 2000, 25 years later.
Got there. Yeah.
It still hasn't got there.
Yeah.
So from that standpoint, people who bought that was a good company. That is a good company. It was a good company. If people bought that at the peak, today they still would not have any profit from it.
So I think what you're saying, AAA, I think what you're saying is history doesn't necessarily repeat itself, but it rhymes, right? It's a different flavor. It's not trains. We're not talking about trains this time. We're not talking about the radio this time. We're not talking about the .coms. We're talking about AI, but it rhymes. And those who don't learn from history are doomed to repeat it.
And one of the things that offsets that whole concept is diversification. True diversification will help offset. Don't put all your eggs in one basket. So I'm not saying don't invest in AI. I'm saying don't make it the major piece of your whole portfolio. I mean, Daniel, I know several people that have Apple as their major piece of their portfolio. They bought it originally really low, and it has increased very big, and it is probably 75% of their portfolio. That's ridiculous. That's not a good strategy to have. The fundamentals of that concept are bad. So you're listening to Financial Strategies with Daniel Agemy. Today's topic is boom or bust, the next AI surge or another bubble for retirees. And whether it's the market, it's AI, whatever, right? Boom or bust. How is your portfolio and retirement portfolio set up at this time? We have a paper that we put together for today's show that goes along with this. And, we're all tuned toward retirement strategies and that kind of thing. And today's paper is called 7 Risks to Your Retirement. There's many risks that come about. We all face risk every day. And if we were totally risk averse, we would never do anything. We would never leave the house. But, there are different things that we need to know what is going to face us so we can deal with it, like longer lifespans, spending principal, underestimating inflation, underestimating healthcare costs, right? Counting on stock market growth to help engineer income, relying too much on Social Security, unexpected events. These are some of the 7 risks to your retirement. Love to put this paper in your hand to be able to help you know what you don't know, educate you further so that you can make smart decisions as you move forward. Yours for free by calling us at 800-725-7616 for your free copy. 7 Risks, ask for it by name. 800-725-7616. You listen to Financial Strategies. This father and son team coming to you to help educate you because people don't know what people don't know. Today's topic, boom or bust. All right. Wow. So, Daniel, the topic is the next AI surge or another bubble for retirees. And like I was just mentioned, it could, AI, but, it's not just limited to AI, right? There's other things that are going on that there's a lot of people have made a lot of money in the stock market over the past, especially 5 years. But the key is buying low, selling high, diversification, averages fool us, all kinds of things to be considering.
Right. And purpose. What is the purpose of that money? So to figure out, is it high or is it low? Again, there's plenty of analysts out there that think that we're going into the next boom. And there's a lot of analysts that think we're going into the next bust. You and I are not here to tell people which direction it's going to go. But what we are here is to bring some facts and let these smart people make up their minds, right? Let these retirees make up their mind. And it's different if you're in your 20s and your 30s than if you're in your 60s or your 70s, because your purpose is much different. Your time frames are much different. So where are we today? It's November 2025. Your birthday's coming up. Happy birthday, AAA. Right? We're in here November 25. And we can look at some different indicators. So if we look at, let's say, the Buffett Indicator, which basically what that does is it looks at the total value of the stock market And then it looks at the entire economic output, right? And economic output is important. Why is it important? Because companies are doing economic input. They're earning profits. They're growing the economy. And valuations are kind of based off of how they're doing. If they're not doing good, valuations are lower. If they're doing really good, valuations go up, right? Because stocks are not chess pieces. Stocks are not, we're not gambling. It's not the casino. It's not supposed to be. You're buying a company that's producing something. It's producing cash flows. I was talking to somebody the other day and trying to explain valuation. And I was like, this company made $4 billion of profit and the gross profit, and the company's trading at $475 billion market cap. And those numbers are too big for people to comprehend, right? So I said, if you had a company and you were earning you were earning $4,000 a year in profits, and somebody came and offered you $475,000 for your company, would you jump on that? You wouldn't even think about it. You'd be like, of course I'm going to sell it, right? And in reverse, would you pay someone your $475,000 for a company that gross generated $4,000 a year? So when we look at these not as going up or going down or market chips, not chips, but we look at them as companies and what we would accept or what we would pay for something. That's what we're talking about when we're talking about these valuations, right, AAA?
Right. And, I try to make it very simple and say, hey, would you want to pay $100,000 for a $40,000 Lexus? Who would want to do that, right? But if you had a $40,000 Lexus that you just bought and somebody came and offered you $100,000, you'd be all over that. Yeah, I'll sell for $100,000. I'll go buy me another for $40,000 Lexus, and I'll have $60,000 in my pocket. But that's what's happening right now with the market. And we've talked about why. Because there's so much money out there, so much money going into the market from 401ks and everything else that they have to buy this stuff. Even if it's not worth it, it drives the price up because it's an old supply and demand kind of thing. So anyway, you're listening to Financial Strategies with Daniel Agemy, and we're excited today to bring to you Boom or Bust, the next IA surge or another bubble for retirees. And our heart is really toward helping retirees be able to retire and stay retired. Those people who are maybe 50 years old and older, in or close to retirement. Now, all our stuff is geared toward that. And so we have a video book that we love to put in your hand today that you can take. It's got 3 different tracks to it of animated videos explaining retirement, different pieces of retirement. Maybe it's Social Security, maybe it's required minimum distributions, maybe it's investing for dividends, whatever, several different topics. But this book will have 3 different animated topics, easy to read, easy to watch, easy to understand. And we love to put that book in your hand. You probably haven't seen anything like this. So, because you're listening, we love to put that book in your hand. To the next 5 first-time callers, 800-725-7616, 800-725-7616 for your free video book. Ask for it by name, video book, 800-725-7616. Call now.
Important financial question. Are you feeling confident that you have enough money saved to enjoy a stress-free retirement?
Honestly, I'm not sure.
That's where Retirement Income Source's investment advisory arm comes in. We exist to help you invest your money smartly.
I'm struggling to accept my retirement without a steady paycheck. So can you help me invest into a profitable revenue plan?
Absolutely. We have top advisors nationwide who have a fiduciary obligation to you, helping you generate retirement income.
This is Financial Strategies with Andrew and Daniel Agemy.
AAA, some people may have heard of the Oracle of Omaha, right? The guy sitting in his office out there in Omaha who somehow seems to always know the bottoms and the tops, right? When to get out and when to get in. Now, it might be more of fairy tales than actual truth, but he's done pretty good, and that's Warren Buffett.
Yeah.
AAA, we're going to talk about the Buffett Indicator and why people look at Buffett Indicator. I'm Daniel Agemy.
And I'm Andrew Agemy, and welcome back to Financial Strategies with Andrew and Daniel Agemy. Today's topic, boom or bust, the next AI surge or another bubble for retirees. Well, Daniel, that's a great thing. The Buffett Indicator. Now, we finished just before break, we talked about how the valuations and how skewed they are right now. But the Buffett Indicator tells us that same kind of thing. Kind of like how skewed everything is.
Yeah, because the goal of investing is buy low, sell high. And human nature, we want to do the opposite because when things are bad, we're terrified. We don't want to touch stocks with a 10-foot pole. We don't want to touch investments with. We want it nice and safe. But when things are going good, we just think that they will continue to get better. And so we don't know the answer. You and I don't know the answer if we're going into a boom right now or a bust now.
Yeah.
All we know is looking at history, what has happened in the past, and what works well going forward. And so when we look at the Buffett Indicator, basically, as I said before, it looks at stocks, it looks at the valuation of all stocks, market cap of stocks, and it looks at GDP, right? Or it looks at the entire economic output. And it says, typically, the economic output and the value of stocks are equal. So if that's 16 trillion on the economic output, $16 trillion on all stocks, that's 100%. They're even.
Yeah, right.
And in the tech bubble, the 2000 tech bubble peak, that Buffett Indicator hit about 140%. Okay? Normally, like I said, it's 100%. And today, November 2025, it's at 221%.
Wow. That fits right in line with what I was saying about that $40,000 Lexus for $100,000. Nobody wants to pay that. But if somebody wants to buy yours for that much, yeah, you're all over it. Because that's around, if my calculations are right, that's around 220% more than what the 40.
Yeah. So that historical average is right around 100. So we're far above that.
Yeah.
And so again, that doesn't mean we're having a crash tomorrow. We're not trying to say that, but what we're saying is it's higher than it usually have. Actually, it's higher than it's ever been.
Right.
This is the highest that it's ever been.
What was it around with the .com era, Daniel?
140%.
Wow. So when I started saying, well, hey, this is kind of smelling, looking like, 2000 or thereabouts, this is far beyond that from at least the Buffett Indicator.
From the Buffett Indicator. We could look at another ratio, right? The CAPE ratio. And basically what it is saying right now is you're paying 40 years worth of earnings for the current stock market. And historically, the average is 16 to 17 times. So 16 to 17 years of earnings for the market. Right now, we're paying 40. Now, it did get higher in the 2000 peak. It was about 44 times.
Okay.
So this one is not an all-time high. This one is right up there with the all-time highs. But it is, an average is 16 to 17. And that makes sense. That makes sense. If you're paying 16 to 17, you'd probably like to pay 8.
Yeah.
Probably like to pay 8.
I want to discount
basically,
yeah.
Again, that is like you're paying 8 years of earnings. So if you're buying a company, don't think about the stock market. If you're going to go spend your hard-earned money to go buy a company to get earnings, you might pay 8 years in advance for those earnings, because you're going to keep the company for 20, 30 years, and you're going to grow the profits. So it probably will be less than that. 16 to 17 starting to get, a little crazy. But if you're talking about 40, you're going and you're buying a company from somebody, and you're paying 40 years worth of earnings for that company. I don't know anybody that's doing that if they're going and buying a full company, right? Nobody would do that. But we're doing that if we're buying markets or holding the stock market There's a lot of other things besides stock markets that people can invest in that's different, but we're just talking about general U.S. markets right now.
Yeah, that's like, whether you're investing $100, $1,000, $10,000, $100,000, right?
Yeah.
At that rate, you're talking about 40 years, before you actually get your money back, kind of thing. You make your profit on it. And unless you're 20 years old, time is not on your side.
Well, yeah, and we have numbers on that. So let me get those numbers quick, Triple, because when we look at these kind of crazy valuations.
Yeah, I want to hit that, Daniel, but I want to just do a station ID on this. So you're listening to Financial Strategies with Daniel Agemy, and today's topic is boom or bust, the next AI surge or another bubble for retirees. And today we have a book to go along with today's show that we love to be able to put in your hand. This is written by a friend of ours, Jeff Small, who has done a masterful job in writing Turning Financial Planning Right Side Up. And Jeff does a great job of putting financial planning into the everyday language. If you're an engineer or that kind of person with that kind of analytical background, you'll really love this book. But even if you're not, you'll get some good stuff out of this to be able to help you understand how to prepare and how to bulletproof your portfolio rather than having maybe a more fragile portfolio. Love to put this book in your hand for free. Turning Financial Planning Right Side Up by Jeff Small. 800-725-7616 for the next 5 first-time callers. 800-725-7616. Call them now. Daniel, as we're talking about boom or bust, and you were just going through the Buffett Indicator, we're way above the Buffett Indicator. We're around the CAPE ratio all-time high, and you're going to give some other examples. So please tell us about those comparisons at this point, please.
Well, AAA, you were saying how when we look at returns, right, our returns are based off of an average earlier.
Yeah.
And so the average matters from where you start from. We were also saying how you wouldn't want to pay, let's say, 40 times revenues or 40 years of revenues for a company.
Right.
But let's say we do pay those valuations, okay? Let's say we do, or we look at these all-time peaks and we see what historical returns have been after that. Okay. And so historical returns after valuations, like what we just talked about, a Buffett indicator of being 140%, and we're at 121% right now, or the CAPE being around 44, or we're at 40 right now.
Right.
The historical returns for the next 10 years have been an average of minus 1%.
For the next
10 to 1 or to minus 1%.
The next 10 years or the past 10 years?
The next 10 years.
The next 10 years.
If we look at these valuations, then
okay. All right.
From these high valuations, the average returns for the next 10 years have been minus 1 to 1%.
Okay. Terrible return.
Yeah.
Yeah, with a lot of risk associated with it.
Right. And now today is not about dollar cost averaging. We've talked about how dollar cost averaging, if you are young and you're buying, that can be that can work out for you. It's still not fun to go through anything like that. But think about that. The last 10 years have been above historical average returns. Okay. So it would make sense that at some point you're going to have below historical average returns. If you're near or close to retirement, that can be serious. So, minus 1% to 1% returns for the following 10 years after these types of valuations. Now, again, this time could be different. So let's see what Goldman Sachs has to say, what they expect the next 10 years to be. Goldman Sachs.
Yeah, what do they say?
They're expecting an average annual return for the next decade of 3%.
An average of 3% for all the risks that you're putting forth and losing principal in the market? That's crazy, right? And it's an average, right, Daniel? Because some years it might be a negative 30. The next year you have to do maybe 50, 60% just to get back to even, which is a zero return, even though you did. Now, if you got in after it had dropped 30%, well, that's a great thing. But most retirees or pre-retirees are not doing that. That's terrible.
You don't know. It's an average, so you don't know what it would do. There's a possibility because things are so expensive, we could grow our way out of it. So that would look like just no growth, no crash, no growth, and just over 10 years, 3% average, right? Another, which historically has happened, is we go excessive and then we go down below the averages. So if we're at a CAPE of 40 years worth of earnings right now, we're paying 40 years worth of earnings for a company. And the average is 16 to 17. We don't go down to 16 or 17. We go down to maybe 8 or 9 and then come back up. That's how it's worked. So there's a couple ways to get back to the average. One is the economy keeps growing, but markets don't, and you average it out. Another is you have a crash where you go down way below and then you come back up. And so this needs to be on people's minds, or if they are trying to get the last drop out of the lemons, right? Squeeze the last drops out, or if they're prepared for this, because that makes a big difference if you just only make 3% for the next 10 years, or if you have a huge crash and then eventually come back up. For a retirement, for somebody's retirement, it's life or death, because it's like we just have to calm spending compared to we ran out of money in retirement.
And what keeps coming back to me is the risk, the word if, right? IF. If all this stuff works, that's what we're talking about. I mean, it could go better. Boy Scouts, are ready for, and Royal Rangers are ready for everything, right? And they prepare for the worst. They hope for the best, but prepare for the worst. And that's kind of our attitude, trying to build a bulletproof portfolio rather than encouraging people to have fragile portfolios. You're listening to Financial Strategies with Daniel Agemy. Today's topic is boom or bust, because people don't know what people don't know. Is your retirement portfolio ready to boom, or is it ready to bust? Here's some questions for you. Are you really ready for retirement? Do you have a written retirement income plan as part of your portfolio? Have you determined the optimal age to claim Social Security? Do you understand what Medicare does or doesn't cover? These questions and a lot more are questions and checklists on our retirement readiness checklist that we love to put in your hand. Just because you're listening to us, we want to give you more materials so that we can educate you to be an educated consumer and to be able to make smart decisions. Because we believe that an educated retiree is a happy and stress-free retiree. And so we love to put this checklist in your hand. Are you really ready for retirement? 800-725-7616. Call us for your free copy, or hit us on the web, agemy.com, AGEMY.com. The two words, Agemy, spell our last name. Retirement Readiness Checklist, 800-725-7616. Call now to get your free checklist.
Time for some tough questions for these financial advisors. What makes Retirement Income Source different from other financial?
Our extensive experience generating investment income quickly so you can have financial peace of mind, navigate your retirement smoothly, and have more time to spend with family and doing the things you love. Honey.
We gotta talk to these guys. We're done here.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
Oh, during the Wild Wild West days, right? Back in time when buffaloes were roaming the land out west, my understanding is how Indians and others would catch these buffalo, because they would use them for a lot of things, but not just food, but a lot of things, is that they would stampede them and get the herd heading toward a cliff, and then they would just fall off the cliff and die. And then, of course, they would scavenge the remains of these buffalo from that standpoint. And that's a great example of the herd mentality, following the herd. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about boom or bust. AAA, Are we in a boom or are we in a bust? What does
well, time will tell, right?
Yeah. What does buffalo herding have to do with boom or bust, with markets?
The market, one of the points we were bringing out in the first half of the show is that the market is high right now. And the whole thing about investing is buy low, sell high. But what is low and what is high? And right now, our point is the market is high. So maybe people need to reposition their assets to build a bulletproof or robust portfolio rather than having a fragile portfolio. To diversify more, take some of the profits, do some changes, right? But how did we get to this point like this? And one of those ways we got to this point is the herd mentality, right? Where people are just following other people. Everyone's getting rich, and I can't miss out. You might say FOMO, right? The fear of missing out has gotten us to this point. That's one of the many ways we got to this point. We're always talking about the flows of money, and there's a lot of money flowing into the market. So it's got the market to this point to where it is this is just one of many things that got us here. The herd mentality, fear of missing out, the flows of money, right? And plus there's other things that got us to this point to where we are now.
Yeah. Well, Andrew Sorkin just wrote a book, and it's on the 1929 crash. And it is fascinating when we look at that, how many parallels there are. And we could use 1929. Everyone is dead from that whole debacle. And so that's usually what happens. Once everyone is dead, the stories stop being passed on. And so he had a very difficult time even writing this book, because it's like an investigation. There's not information. So how do you tell a story about a real person when there's no one who could tell you the story? And that's what tends to happen. We could use the .com bust too, because they tend to be
more recent,
similar, but the same mantras are happening, right? AAA. And so the bubble recipe. Well, what is the bubble recipe? The bubble recipe is straight from 1929, and we could use any bubble. They all have the same mantras. It's a new era. There's a new era. Is it radio? Is it electricity? Is it internet? Is it AI?
Right.
That's every single bubble, right? It was tulips back in Amsterdam.
Yeah.
So there's always a new era thinking. And then there's easy money. Cheap credit fuels speculation. Right. And in this particular time, it's not these leveraged funds necessarily, although there is some of that out there. There's not margin like there was in the 1929s, where you could give them $10 and they would give you $100 of credit. We don't necessarily have that, but we have ETFs. We have leveraged ETFs. They just launched a 5-to-1 ETF. That means if it goes down 20%, you lose all your money. Like if the underlying stock goes down 20%, you're wiped out.
Yeah.
And options are another way of leverage, right? So there's that going on as well. And who knows what other types of leverage there are going on, because a lot of times we find out about these after the fact, right? But we know about the options, and we know about the zero dated options. So leverage has always been a big part of these. And then, like you said, the herd behavior. Everyone's seen their friends get rich, and they throw caution to the wind because no one wants to see their friend get rich and them not. Nobody wants to go to a party and hear about how much money everybody's making in the market and they're not. And so now there's a word for that, FOMO, right? The fear of missing out. And so leverage and FOMO are the biggest recipe for disaster. Leverage and FOMO.
Right. And FOMO, fear of missing out, is all based upon emotions. And emotions are a great thing to kill somebody's portfolio. And that's why it's good to be able to get a manager that is separated emotionally from the money to be able to help you be able to manage that and be active in that management. But there's all these different things that run parallel to whether, like you say, 1929 or the 2000 crash. And you know what, the 2000 crash, like most people listen to this, remember that. But they may not remember that it took 13 years. If you invested $100,000 at the peak in 2000, it took 13 years before your 100,000 was worth 100,000 again. All things being, and stayed there and never looked back.
But think about how crazy this mantra is, AAA, right?
Yeah.
Think about how crazy this is. Okay. A new era, thinking, right? A new era.
Right.
This new technology is changing the world. Easy money.
Yeah.
Leverage, having the access to leverage. Herd behavior, right? Everyone's getting rich. I need to get rich too. And then disconnected from fundamentals. That is not from today. That might sound like today. That is not. That came out of Andrew Sorkin's book from 1929.
Wow.
From what was going on in 1929.
That's what they were saying back then. Yeah.
That's literally what came out of his book from what people were saying in 1929.
Well, when we talk about history tends to repeat itself more often than not. The reason why history tends to repeat itself is because the one thing throughout history that does not change is people. People are the same from one generation to another generation. By the time that one generation forgets the mistakes of another generation, they make the same mistakes, right? And people are emotional creatures, and that's the one thing that always changes. Even though they say, hey, it's a new era, yeah, but we still have people involved. It's not a new era. It's the same old. You're listening to Financial Strategies with Daniel Agemy. Today's topic is boom or bust, the next AI surge, or another bubble for retirees. And we are trying to, at Financial Strategies, we're trying to educate people to be able to have a robust, sound, anti-fragile portfolio, a bulletproof portfolio that can take you through and weather the storms, whatever happens. And the good times do well, and the bad times still hold its own from that standpoint. And so we have a paper that we'd like to give you to go along with today's show of Boom or Bust, which is talking about beware mutual fund risk. There's a lot of people invested in mutual funds, and mutual funds were created primarily, even though they were been around since like 1936 when they first started, they really started growing in number in the 1980s. And they went from probably about 700 or so mutual funds in 1980 to about, I think the number's like 4,000, something like that by the year 2000. And today you have even ETFs as well as regular mutual funds. So beware of the risk of these funds. There's pros, there's cons. And so many times people look at the pros rather than the cons. And we think you should have a balanced approach as you're looking at your mutual funds. And we love to put this paper in your hand. Beware of mutual fund risks. Yours for free by calling us at 800-725-7616. For your free copy, and no obligation, 800-725-7616. Call now. All right. So as we talk about boom or bust.
When we look at the warning flags, right, the warning signs, we can see things like we don't know. We're not saying that there's a 1929 crash ahead of us, but we can see some of these warning signs, some of these flags, right? Things like extreme valuations, right? A speculative fever. And then this time is different mentality, right? And when we look at those things, we say, well, what can we do about it? Right? Do we sell it all and sit and wait? Right? We've been talking a lot of doom and gloom, just pointing out some of these facts of what's going on in the world. And if people have been invested in the markets for the last 10 years, the last 5 years, especially if they're in or close to retirement, they're already rich. They're rich.
Right.
And one of the things, if you don't like the game, don't play it. If you don't like the rules to the game, don't play it or make up your own game. And there's a game-changing philosophy that has helped us build some of our portfolios from Nassim Taleb, who talks about having an anti-fragile portfolio.
Yeah.
And so fragile is, it can be hurt from almost anything. So fragile would be maybe S&P right now, because what is driving it? Is it fundamentals driving it?
Nope.
Or is it hype and it's 401k flows? So fragile could look like AI is going to change the world, but what that means is it's going to replace people, which means there's not going to be 401ks, which means it's going to crash the stock market. That's fragile. All these different things are fragile. It makes it fragile. There was no robustness, or what Nassim says is anti-fragile. What actually benefits from chaos, right? So if you already have built up your wealth, what do you look at to have wealth preservation or to create an anti-fragile portfolio where you actually benefit from chaos?
Yeah, contracts, right? Debt, right? Because people are always buying, companies are always borrowing money, the government's always borrowing money, and it's a contractual arrangement, which makes things safer. I mean, that's why banks loan money by contract, because it makes the money safer for them. And, in my mind, that is a great concept to be doing things differently, especially when you reach retirement age or in or close to retirement, where you're having to start taking money out, especially with required minimum distributions, or maybe you need it because to live, but the flow of the money is coming out more than it's going in retirement. So you need to have a different way of doing things. All right. This is anti-fragile retirement, creating a robust portfolio, one that can weather the storms, is really key. And you're listening to Financial Strategies with Andrew and Daniel Agemy. And today, we want to offer you an opportunity to find out, can you retire? When can you retire? What would your investments do if we had another 2008 or financial crisis? What would your investments do if we had another run-up like we did in 2013 in the market where it went the other way? Is the risk that you're putting forth in your portfolio the risk that is how you define risk? And is it worth the potential return? All these questions and more can be started, and an answer to these can be started by having a RRR conversation with us, a retirement readiness report conversation, to where we can address these. And we'd love to be able to have that conversation with you for free by calling us at 800-725-7616. 800-725-7616 for your RRR conversation. 800-725-7616. Call now.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you, so you can enjoy your retirement with a little more income stability.
I'm in.
That's 2 out of 3.
This is Financial Strategy with Andrew and Daniel Agemy.
AAA, there is a philosopher named Nassim Taleb, and he wrote a book called Anti-Fragile. And basically what he does in the book is he explains why some portfolios strive and get better throughout chaos and others get destroyed. And he uses mythology to teach how that works. And the story about Hydra, who when Hercules cuts off one of its heads, it grows back with 2 heads. That's an anti-fragile portfolio. But Damocles, who has a sword hanging over his head, it's just hanging by a thread. And if you have almost anything happen, that thread could break and kill him. That's a fragile portfolio. I'm Daniel Agemy.
Yeah. And I'm Andrew Agemy. And welcome back to Financial Strategies Radio with Andrew and Daniel Agemy, because people don't know what people don't know. And we want to educate you to be able to at least know what questions to ask so that you can retire and stay retired. Daniel, that's an interesting thing, talking about that whole thing and the anti-fragile portfolio for somebody is, a fragile portfolio is certainly not something that most people don't like fragile things, right? Because they break too easily. And I am so glad that we're talking about this today on our show, because people, I'm sure, don't think about their portfolios as being fragile or anti-fragile. And that's our job to think that and to educate people on that. So that, because with our clients, right, when the markets go awry, they're holding us accountable for what's going on with their portfolio, right? I mean, we had some clients recently saying, hey, I didn't make my portfolio with you, didn't make what happened with my 401k over the past year. Well, number one, that's over the past year. That's not an average, right? And the past year has been a good year. And so, like the show we did before on building your all-wheel drive SUV retirement vehicle. And that's an anti-fragile portfolio. So that's pretty cool to be able to do that and build that upon, the foundation of that portfolio is built upon income, because that's what you spend in retirement. Replace your check, income, dividends, and interest.
So a fragile portfolio breaks under stress. And most people's portfolios are fragile. Like, most investors have a fragile portfolio, and it can perform amazingly when there's FOMO going on. It can perform amazingly when there's liquidity going on, and it can be fun and it can be crazy. And that could potentially work for people if they love volatility and they love the thrill of ups and downs, and they have time on their side. AAA, that's not the way that you invest. That's not the way I invest. That's not the way our clients like to invest. But some people may enjoy that because it's exhilarating. You could blow up doing that very easily as well.
Right.
And then there's robust portfolios, and we talk about robust portfolios all the time. And that shows some diversification, and that can withstand market turbulence. But then there's the anti-fragile portfolio, right? And that's where it actually benefits from chaos. And when we talk about Demarest and we talk about the sword hanging over his head by a string, that's what a lot of people are in right now when you're talking about S&P and the U.S. stock market, where it needs everything to continue to go just right so that string doesn't break. And we talk about, well, we need rate cuts now. Let's have some rate cuts so we can keep going up, right? And we talk about flows, like money's being forced from your paycheck into the S&P, into U.S. stocks. And as long as that keeps going, that string is not going to break. And we talk about international as well. If the dollar is good and international money keeps coming into the U.S., it's good. But do you hear anybody talking about if any of those things stop? Right? These valuations, as long as these valuations, if we go from a 40 years of earnings right now to 50, that string's going to be there. That makes me want to go sell even more stuff.
Right, exactly. But the thing you're talking about, Daniel, and when you say, people, you hear anybody talking about these other things? No. But those are the talking heads. But the thing that I'm concerned about, that I want our listeners to hear, is that maybe you have that string with that sword over your head and you haven't looked up and seen it. You get, how many people have their head in the sand like the ostrich and are not paying attention to the handwriting on the wall, so to speak, to be able to change? Or people may know, well, there's nothing to change to. Well, there is things to change to, right? There's all kinds of ways you can invest and make money in all kinds of different fashions and all kinds of different markets. The question is, what's the right thing to fit that time frame? And that's the thing that gets me when I think about all of this, Daniel, is do people even realize what's hanging over their head? You're listening to Financial Strategies with Daniel Agemy. Today's topic is boom or bust, the next AI surge or another bubble for retirees. Today, we're talking about this and we're having a good time talking about this. We have a book that goes along with today's show. We'd love to put in your hand to the next 5 first-time callers, Turning Financial Planning Right Side Up by Jeffrey Small, where Jeffrey does a masterful job of explaining the traditional financial planning with alternatives that can make you money in retirement that you probably don't know about prior to retirement, because you spend 20, 30, 40 years accumulating money, but when you're in and close to retirement, you need to start distributing the money. And the biggest mistake people make is they don't switch from an accumulation standpoint to distribution standpoint at the proper time. And that's kind of the premise behind turning financial planning right side up. And we'd love to put this book in your hand for free by calling us at 800-725-7616. The next 5 first-time callers, 800-725-7616. You listen to Financial Strategies with Andrew and Daniel Agemy. Boom or bust, baby. Fragile or anti-fragile portfolio.
Yeah, AAA. That is such an important thing to understand, is if you're in that fragile portfolio where it's fun and it's exciting and it's going up, or are you in something that can benefit from chaos, especially when we're at these spots where valuations are so high? That doesn't mean we're having a crash tomorrow. It doesn't even mean we're having a crash this year.
Right.
But are you in a position where if that does happen, or if these valuations come down, you can benefit from that? And when I think of benefiting from that, there's a couple different ways, right? Because there's a lot of scenarios. And the same writer, Nassim Taleb, is the one who kind of came up with the whole black swan principle, where there's a black swan, right? And people talk about that in finance, where it's an unknown. You can't predict it. The very nature of a black swan is you can't predict it. It's something that happens that no one expected to happen. There's plenty of white swans out there, but people didn't even know there was actually black swans. And then they saw that there's black swans, right? And that's where the black swan concept came from. But the thought is, like, how do you benefit from chaos? And so the idea is, if you have the majority of the money in things that can pay you, that are stable in all scenarios, and then you have some things that are asymmetrical, that they benefit from certain environments. And so that's what we've had with some gold and some Bitcoin and these royalty and streaming companies, where they benefit 2 to 5 times for every $1 that's printed. And as there's been liquidity being added and there's inflation, these things benefit 1 to 5 times, 2 to 5 times for monetary debasement. And that's worked out very, very well for people. You don't need the whole portfolio to be in that. You have the majority in things that sit there and are stable and pay you. And then you can add some of these asymmetric things that actually benefit from chaos, right?
Yeah. Yeah, a balanced approach, diversification. You're right, Daniel. I'm right with you. Go.
Yeah, and so you get those asymmetric opportunities in there. In the past, we've used things like royalty and streaming companies. We use international dividend stocks. We've used Bitcoin for certain people, or just gold, right? The other thing that it does is what the income allows you to do, and how it allows you to benefit from chaos, is if you've stopped saving because you've retired, or you don't have a job, or whatever it is any longer, the income is this huge force of money coming into your portfolio that now you can take advantage of situations. And it turns bad situations, or it turns chaos, into an opportunity for you again. Because if you got $1 million portfolio, you could have $60,000 a year that's just pumping into your portfolio. And it's not based upon markets going up or markets coming down. It's based upon contracts, as you were talking about earlier, right, AAA? Some practical steps here that people really need to look at, especially if anything that we talked about today resonated, AAA, right?
Right.
These crazy valuations, if that resonated.
Yeah.
Think about, number one, write it down. Calculate what kind of income you need. What kind of income do you need to stop working? Don't think about what kind of portfolio do you need, how much money do you need. Think about what you could live off of and have the lifestyle you want without going and collecting a paycheck. And then you build towards that income number, right? We can help you build towards that, or you can look into and do the research to figure out how you can build income to get that number, because that's when you can retire, is when you have more than the income you need to support the lifestyle that you want to have.
That's right.
And then look at your diversification in sources of income. Don't look at how much stocks do I have, how much bonds do I have. Don't look at that. Don't look at, well, the S&P is diversified. It's got 500 stocks in there. Don't look at that because there's tons of concentration work. Look at how many sources you're getting income from. What types of sources of income am I getting? And can that hold up? Can that benefit from chaos? And then look at your asymmetrical bets. What kind of asymmetric bets do you have in the portfolio? What kind of bets do you have against chaos? And then lastly, avoid concentration. Look at your concentration risk. AAA, that white paper we're giving out or that educational brochure and what you've been talking about is why do ETFs become so dangerous is because people don't understand the concentration risk and fees inside of those, right?
Yeah, right.
And so you see a bunch of names of funds and you don't know that they own the same things inside of them. That can present huge risks that you think you're diversified, but you're not. And so that's why I'm not saying look at your funds and see if you're diversified. I'm saying look at the different sources of income and look at your diversification from how many places you're getting paid from, right, AAA?
Yeah. That's good advice, good education, Daniel, for our listening audience. Yeah, and that's a great way to wrap up today's show. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is boom or bust, the next AI surge or another bubble for retirees. And we're trying to educate you to be able to make smart decisions. If you need more help, please call us at 800-725-7616. We're glad to help any radio show listener with to field their questions. But questions like, are you really ready to retire? Can you retire? When can you retire? What's going to happen to your portfolio if we had another 2008 or financial crisis? A lot of different questions to be asked. And we have a checklist that helps you be able to understand those and what questions to ask that we'd love to put in your hand today as a parting gift. No obligation by calling us at 800-725-7616. Call the Retirement Readiness Checklist. 800-725-7616 for your free copy of the Retirement Readiness Checklist. And until next time, we're trying to educate people because we believe that educated retiree is a happy and stress-free retiree. And remember to invest more if you want your retirement to be stress-free. Invest more for the I rather than the G. Until next time, be well.